Howdy there, folks. Welcome into today's video. It's a buy one, get one free today in this one to get your week started. Okay, first one up here, Tom Lee explains why he sees an all-time high in the S&P 500 this year. Man, you can tell how bullish the market is based upon how many times Tom Lee goes on CNBC, and he has been on CNBC like non-stop lately. So we're going to hear what he has to say. I want to react to that one, give my perspectives and opinions on that one, okay? Then Mr. Ed Yardeni from Yardeni Research, we're going to hear him speak about a few different subjects, including one, which is inflation has been much more transitory than persistent, okay? Sometimes I show you guys some different Yardeni charts out there, so I thought that would be an interesting one to react to. This one's from 4 hours ago. This one's from 3 hours ago here. So appreciate everybody joining me as always. Thanks so much for being here, folks. Thanks for being subscribed. And my camera, okay, we're switching cameras with this camera now. Thank you for being here, folks. Thanks for being subscribed. Even if my cameras consistently want to change for absolutely no reason that I can never figure out, I still appreciate y'all being here, okay? And I'll try to look at the right camera in this one.
Exactly week. Was it 6:15? Tom, I think it was right about the same time last Monday. Fundstrat's Tom Lee joined us with a tactical buy. It said it would be a 100-point gain or more in the S&P when the CPI came in cooler than expected. Here's what he said.
We thought a tactical sort of opportunity was emerging because last week the market sold off because the jobs reports are strong, yields really popped. So investors are kind of fed higher for longer, a little bearish into this week. And I think core CPI could come in at 0.2 or better. So it could be a huge downside surprise.
And that CPI reading did indeed come in cooler than expected. And the S&P finished last week at 45.05. I think it was 33.98 is where it closed the previous week. So that's 107 points. Joining us now to follow up, Tom Lee, a co-founder of Fundstrat Global Advisors and a CNBC contributor. The thing is, Tom, you had to be right about the CPI, and that's pretty good, but that was kind of expected. But then you had to be right about the reaction, which is on any data that comes in, you never know because it's good as bad, bad as good, good jobs numbers, bad job. You just never know. So in that case, you had to be right about both, and you had to be right about the, how.
That's a tough part, is being right about how the reaction will be to the market or to stocks. And this is something I got bit by real bad. I don't know if you guys know this story or not. But in around 2015, I started to try to do like swing trading and basically kind of went away from long-term investing for a bit, even though it did me so well for so long. I was like, oh, I can also swing trade. I can get these earnings right. And a lot of times I'd be right on with the earnings, and the revenue and the EPS would be like right where I thought it was going to be. And then the stock would go down. And I'm like, what the crap? I was doing like heavy margin stuff, and I put like $100,000 in a stock like this day and move it over to this stock. And it went horrible. And one of the reasons is just because you're right about whatever data or information, it does not mean the stock market will react the way you think it's going to react, okay? So even if you're right about the numbers, as, even if you're right about CPI, it doesn't mean you could be, for sure that the market's going to go up or down, because one time it looks at it as a good thing, next time it looks at it as a bad, or looks at some other data point, and it's a crazy
large
market.
It was, and the timing, which is not something you want to do a lot. You're not going to.
Which is why it's so hard to be a short-term trader.
Do that this week?
As you mentioned last week, it wasn't wise to do that last week, and yes, I don't think it was wise to do, but I thought it was important at the time because our clients were quite nervous about hot inflation after those job report numbers, so we just thought it was an opportunity to make a trade.
But it's a trade, but what was more important for me was that as we tested the 4,200 level, which most people saw as a reflex rally or a rally in a bear market, and even when we got through it, it was like, well, we're still at the high end of the range. And to make the call that we will significantly go above 4,200 and break out of that range to almost a new bull. I don't know whether the S&P actually is up 20%, but that was what was significant. Now, I don't know what that means from where we get. We could still turn and go back down to 4,000. That's what we need you here for. Is that going to happen?
Well, 45.05 is a very important level for markets because it is a 76% recovery, Fibonacci from the 2022 highs to the lows. So now that we closed above it, I actually think the probabilities favor us going back to the prior highs. So we've cleared 45.05 essentially becomes support now.
That's interesting. So most people, I've seen the latest thesis is that we got here, but new highs might be a couple of years away. We could do more threading. Do you think we hit new highs this year?
Yes.
All-time highs in the S&P.
Yeah, I think we'll be well above the prior highs.
Well above the prior highs.
Yes.
What do you put the prior high at? What's the exact number?
The crazy thing is about this, Kate, let me share my perspective on if we hit highs this year in SP 500. I have news for folks. If earnings season is incredibly strong, if guidance is incredibly strong and companies come in and basically have strong forecasts and are not very worried, we'll be at all-time highs at the end of earnings season. We're not that far away from all-time highs on the S&P 500. We just need a kind of a let's call it a booming earnings season where CEOs say they're a lot more confident in their businesses moving forward than they were the past quarter. If that happens, you're at all-time highs out there in a month. You know what I mean? So yeah, it's not like we're some crazy amount away like we were when we started the year, where that was impossible to imagine. Now you're only a little ways away now at this point in time, folks. So yeah, I mean, everybody's talking about by the end of the year, and it's like it could be in a month from now if earnings season really comes in. Now, if earnings season, all these CEOs are still really scared, they're still really shaky, cloudy, then you could be waiting longer than that, obviously. But if everybody's a little more confident, oh my gosh, what that will do to investor bases is going to be massive if that's the situation.
48.19.
48.19. So that's another. You think another 10% this year or more?
Or more, yeah. I mean, I think there's even a chance that we could be, close to 5,000, but a lot would have to go right to get towards 5,000.
Like a soft landing?
A soft landing and earnings visibly have to start turning. I think this quarter, about half of the S&P is going to start posting earnings growth. And, by the end of the year, it may be 100% of the S&P posting earnings growth. There's still $5.5 trillion of cash sitting on the sidelines. That's almost $1 trillion higher than it was at the start of the year. So there's still a lot of skepticism. And then inflation has to be on that glide path lower, which we're pretty confident that what we saw last week on CPI, the core being 0.2, you might see 0.2 or less in July and August. So if we get a few more of those, then...
But how much of this is dependent on, where are you on what the Fed does then? In all this?
Well, I think they've committed to a July hike, so
right.
that 25 basis points is there. But then I think that there's going to be a debate whether that's the last hike for the cycle.
And is that part of your calculus in terms of where
To be fair, that's been a debate for 6+ months now at this point in time.
numbers?
One more hike, I think you could still get to all-time highs. So something in November.
Maybe even two. Oh, you think 50... I was thinking 25, 50. We're sort of splitting hairs here. I don't
That's
know
right.
if it
Yeah,
matters that much.
one or two more hikes, I don't think hurts all-time highs. But if the Fed,
The important thing to remember about, if the Fed keeps raising rates, okay, this is extremely important for everybody to understand that if the Fed keeps raising rates, okay, and if they keep rates in an elevated place for, let's call it a year, 18 months, something like that, the thing you have to understand is that means essentially is a much higher risk of a significant recession. Much higher risk, okay? So far, we've slid under the radar and we haven't had unemployment go up. We've had, credit start to contract and those sorts of things. And we've had some shakiness in some pockets of the economy, no doubt. But we haven't really gotten hit yet, right? But if the Fed keeps raising, and if they keep rates there for a longer period of time, the more you have a significant risk of, guess what, a major recession. And so I think that's just an important thing for everybody to kind of understand about this market. The Fed's decisions eventually will catch up to things, right? The Fed lags eventually hit.
thinks inflation is a lot stickier, and then maybe terminal rates of 6, that would obviously be a headwind for stocks.
So tell me your crazy Bitcoin stuff again, because it always seems crazy, and then sometimes it happens. But 100,000 by when?
Something around 200,000 within 5 years.
200,000.
Yes.
Within 5 years.
Yes. And there are.
This is a better prediction than 100 points in a week. 5 years, I think, is much smarter for you, because we could all be dead.
It's a better time frame.
Right.
We may not be there to. Our window might be closing.
200,000.
Yeah.
Because what? Just give us the underlying thesis here.
Well, Bitcoin's very useful. I think in the U.S. there's a tendency to think the financial system works well for everybody, but for people who have
Right.
money, it does work well. But even in the U.S., 46.
But do you need an ETF for that to happen? For example, do you need all sorts of other things in the regulatory scheme to change for your numbers to get to where you want them to be?
Yes, you do. It is flows.
Okay.
I think the Bitcoin ETF. I think people underestimate how important that will be because.
Because you think mutual funds will then buy it and other people will do it?
Yeah. And the multiplier right now is roughly 4 to 1, meaning a dollar of inflows is $4 to the change in the price of Bitcoin's market cap. So, if you get 100 billion or 200 billion of demand, that's,
Right.
800
But if you don't
billion.
get an ETF, for example, then what?
Well, then you're going to rely on sort of organic network effects. But I do think an ETF, is very likely, but that would also be a very important and underestimated catalyst.
Great. Got a lot of predictions there that are going to be testable once again, which you don't shy away from, which is why we love you, Tom. Thank you.
Yeah, so interesting predictions out of Tom Lee as always, Kay. Since the market's still open, let's take a look before we get into Ed Yardini, and let's see. Hey, you guys aren't supposed to see that. Let's see what we got going on here today in the market. Okay, so we got, it's definitely a risk-on day. If Oatly, Fubo, and Palantir are leading things for me, then it definitely means a little risk-on. Tesla minus up 2%. Look at PayPal starting to roll, baby. Day by day by day. Looks like laggard today is Avant. RH. Disney's not even one of my stocks anymore. Delete you. And other than that, yeah, kind of a mixed bag day out there. Looks like we're about half green, half red. So, but we're definitely more positive than negative. Mainly because whenever I see Meta and Tesla positive, those ones just carry such heavy weights for me. Like, that's going to carry pretty much everything else. Alrighty, Ed Yardini, let's hear what you have to say, sir.
More on the markets. Want to bring in Ed Yardeni, President of Yardeni Research. Good morning to you.
Good morning.
We had Mr. Lee on earlier, who has some nice optimism to him.
Right.
It sounds like you're happy about where inflation is going.
Absolutely.
But less happy about how the market's taking it.
Well, I would like to see a civilized bull market here. I don't want this thing getting out of hand. And so I am concerned about a melt-up, because melt-ups are usually followed by meltdowns. But the bottom line is we've been in a bull market since October 12th. We're still in a bull market. If we have a pullback, I think the word is pullback rather than correction. I think that would be a healthy development. But I'm still targeting 4,600 by the end of the year or by the end of the week. I haven't quite figured out the timing.
Oh, but let's talk real economy first, and we'll come back to the market. So where do you really think we are on inflation? Where do you really think we are on what the Fed may or may not do this summer and come this fall?
Yeah, I think the market is kind of overjoyed with a disinflationary soft landing scenario. That seems to be what we're in. I've been thinking for quite some time that we're in a recession, but I argued that it's a rolling recession, not an economy-wide recession. Now I think we're in a rolling recovery. Housing looks.
Do you think the recession piece is we've passed that?
I think we have, and I think we have had, for those who are waiting for a recession, I think we've had it all along. It's just been hitting different sectors at different times, and there's been strength in other areas.
True.
I think the same thing's happened now. We're probably going to go into recession in the commercial real estate.
So then do you give a standing ovation to Jay Powell?
Well, I do, actually. Usually,
No, not yet. We haven't finished this game. Let's not forget Fed funds rate right now is the highest it's been in decades. They're talking about raising rates more. They're talking about keeping them there for a longer period of time when they probably should already be taking rates down. So do not claim victory in this game yet, okay? Because all I'm going to tell you is they might take things too far the other side, okay? And by the time people realize, it'll be too late.
economists and strategists like to be contrary and to say that the Fed is not on the right track, but I think they actually can say mission accomplished. I hope they don't, because that'll be a jinx.
Right.
But look, inflation is down to 3% on a CPI basis on a year-over-year basis. I think that that disinflation is now made in China. The market's down today because of weak China data.
Right.
But a couple of days ago, it was up because of better than expected PPI.
So Jared Bernstein's going to be on. I just thought of a really good thing that he should do. He's going to come on.
Right.
He's going to say, we had nothing to do with inflation being ignited in the first place, but we have everything to do with inflation coming down because we passed
Yeah, of
the
course we
inflation.
will.
So that we know that. And I was going to say to him, Jared, instead of no one really believes that, so it doesn't help your case. It just sounds like we won't be a split. Why don't you say the Fed brought down the inflation rate with its increase, but we gave the economy enough positive things that the economy held up in the face of 500.
Absolutely.
So I would sell it that way.
But
I
they've
would
been
sell
saying
it.
that.
Yeah.
That's what they've been saying because they say we can't control the Fed.
They can say that. They can say that, but to find the actual, none of the policies that we've passed have really been implemented yet. And a lot of this is just a recovery after the pandemic. But they're going to take, you read earlier, they're going to take a victory lap on inflation. The Inflation Reduction Act hasn't been put in yet. That's not why inflation is coming down. Inflation is coming down because of the Fed, but we've had good jobs numbers every Friday.
Right.
So if you're going to really sell something that people might not just immediately dismiss as just total BS.
What about all the supply chain stuff? Because that's been actually the biggest piece of it.
Right, but
And you're not
how
gonna-
did we manage?
How did we manage that?
through that?
Pretty well.
There's always this tendency.
Well, the whole world is
There's always this tendency
reopened.
because of the nature of journalism and financial press to really focus on fiscal and monetary policy and what happens in Washington.
Right.
But I think it's important to realize that a lot of what's happened over the past few years has occurred because something very different has in fact occurred, and that is the pandemic. And the pandemic had shock waves that caused inflation. They caused the supply chain disruptions.
So did the war in Ukraine, and today the deal to allow the
That's a
Ukrainian
trouble.
wheat to come back.
That could be troublesome.
Yeah. So what is it?
That could be troublesome on the inflation.
Well, who managed the
front with
supply
regards to
chain?
food.
The government managed it, or the private sector worked its way around the supply chain
Well,
issue?
I think that what happened is the response of the government to the pandemic was to overstimulate the economy.
Right, that's what caused the inflation. Larry Summers even said that.
Too
so.
many relief checks
Right,
and too much.
No, but do you think they managed? No, but to the point of the supply chain, do you give them
managed
credit
that?
for what they did at the ports? Do you give them credit or not? Did they make mistakes there? Was that the?
Yeah, I'm not
You know what this
into.
feels like? It feels like Joe and the other guy are basically arguing back and forth, but instead of arguing directly, they're arguing their points to this gentleman to try to argue on behalf of them. It's hilarious.
Blaming folks.
It's what I call an indirect argument.
A kind of objective analysis
Right.
of what happened is that the stimulus from all these checks created a buying binge. We all got cabin fever from being at home for a couple of
Right.
months, and when we started
Months?
for a couple of months.
Years.
Well,
Yeah.
the lockdowns.
No, I know, but in general,
saving.
it was a lot longer
But
than a
we had
couple
a buying binge, and we couldn't buy services, so we bought goods, and that's really what caused the ports to clog up. Retailers got fooled, and they ordered way too much, and by the time it got through the ports, consumers already passed on and said no mas, and they pivoted.
But are you ready to keep
pivoted
asking
to
the same
services.
question? How did the supply chain, how was that solved, and how was it reopened? Did the government?
Because the consumer. I don't like to give the government a lot of credit.
Well, I don't either,
For
but-
things, but I think in this case, we had a buying binge for goods. It got satisfied, and then suddenly the demand for goods was such that inventories piled up, and we had the disinflation in the goods market. So
Right.
I would argue that inflation has actually been, ironically, much more transitory than persistent.
Let me ask you one last question with this 4,600 target of yours. How much of that is going to be a function of tech and otherwise the NASDAQ going up versus the rest of the market, given the weighted element that is tech in all of this?
Yeah, I think Mike Santola got it right, is that the market is broadening out. Look, beyond 4,600, I'm looking for 4,800 to 5,400 over the next 18 months. I think that's going to be because there is no recession, because earnings are going to be picking up, and I think because the market will, in fact, broaden out.
We'll see. Okay, we'll see. My hope is he's right about that. It's just a big risk of what does the Fed do? Do these guys really keep raising rates? How long are they going to keep rates at an elevated place? Because the longer they do that, I'm just telling you, like, the more risk of an actual recession there is, okay, if that happens. What happens if inflation starts going up again? Are they going to keep raising rates even if, let's say, inflation's at, I don't know, let's say CPI is at 3.3. It goes back up for whatever reason, which probably isn't happening, but let's just say hypothetically it does. Do they then keep raising rates to 6%, 7%? Like, you know, we're still in the game. Okay, let's just call it that. So appreciate everybody joining me as always. Thanks so much for being here, folks. If you're looking to join my private stock group, I just posted a brand new video in there. Then check out the pinned comment down there. That went into some different hedging opportunities I see for 2024. And yeah, I got a shipment coming today, man. An actual shipment. $13,000 worth of new six-figure awards, because we have a ridiculous amount of folks that are hitting six figures in the market right now. So yeah, if you're looking to join us in there, fill out an application that would be pinned comment down there. Much love as always, and have a great day.